In this section, we're going to be talking about the main types of orders that your broker will offer you. So imagine that you go to a restaurant and you are offered the menu, and if you want steak, then you're going to have to tell them if it's going to be medium rare, if you're going to want potatoes on the side or French fries. So this is very similar to what the broker offers you in terms of buying and selling shares. Using the restaurant example, you are the customer and you are submitting orders, and the restaurant, which is your broker, will fill them when all the requirements are met. One of the first things you need to know is the bid and ask price. So what are those? What we're saying is that it is how much someone is willing to buy and sell the share. The bid price, as you see on the picture on the right-hand side there, is the maximum price that a buyer is willing to pay for the share, while the ask price is the maximum price a seller is willing to take for the share. Imagine two lines of people facing each other, and one is the buyer line, and on the other side is the seller line. The market tries to match people to get the transactions through if there is an agreement of price. These people are submitting orders that are waiting to be filled. A transaction goes through when the bid and ask price matches. Since there's a constant flow of orders, transactions go through regularly, and the ticker price reflects the last traded price. And you see on the spread on the picture on the right-hand side is the price difference between the bid and the ask. So on the example on the right, the spread is only 5 cents. The more liquid the stock, the lower the spread, because there's that many more buyers and that many more sellers willing to buy and sell immediately. So the S&P 500 has a very low spread price because it is one of the most active fund that you can buy, or active ETF that you can buy. While as if you have a low volume penny stock ticker, then the spread can be a lot higher, sometimes more than $1. So for example, if you see the ticker price is currently at $70, the bid may be at $69.90 and the ask may be at $70.20. So it depends if someone's willing to buy at the ask or sell at the bid. And if the stock is in demand, then the price will go up because buyers are willing to move up their bid price to match a higher ask price. Let's take a look at some of the order types you can take and use in this menu. So market orders, they are the simplest order that you can have. Remember that line of buyers and sellers and how they're all waiting for the prices to match up? By placing a market order, you jump to the front of the line because you're willing to buy at the closest ask price. So someone is wanting to sell you that share for $70.20, you buy that share immediately. Same for selling. You're willing to sell at the highest bid price. This way you can get in or out of your shares immediately, and it's useful if you think that the prices are going to move in the direction and you want to get in it as soon as possible. This order is very useful if you think the prices are going to move in the direction you want it to move really soon, and you don't care what price you get in for, you just want to be into that stock, if you're buying, that is. But that does mean that if you want to buy 100 shares, for example, the first 30 shares could be at $70.20, and then the next 70 shares could be at the next price, which is $70.50, and you'll buy a combination of these shares at different prices. The next order is a very important order to learn as well. It is the limit order. It is something that you'll likely be using as a limit order is an order that you can limit the price of how much you're willing to buy or sell for. So you're basically putting down a price and getting yourself in line. You can set the exact price you're willing to buy or willing to sell, and you'll be waiting in queue and waiting for your order to be filled, and you'll get all your shares at that price. There is a chance that your order will not fill given the price never hits your limit order price. And if So if you correctly price at $60 and you set your limit order at $58, then the stock runs up to, say, $70, then your order will not fill. So let's say the current price of a stock is $60 and you set your limit order at $58, and then the stock price runs up to $70, your order will not fill because it never hit $58. But using this order is perfect for setting up your game plan and having good entry prices and exit target prices and also stop prices. The next type of order is the stop order, and they're going to be very important in your trading career. It's how you manage your risks when you're not in front of your trading platform or your charts. And the simplest form is a stop order. It's a basic market sell order when it hits a predetermined price. Generally, we'll be using this as a stop loss sell order for your long positions, but you can always use this stop to buy to protect your short positions. Once the price hits your stop level, it will automatically sell the shares at the market price. Stop limit, on the other hand, is a similar order to the limit order where you predetermine the exact price where you want all your shares to be sold at. And if you cannot sell all your shares at that price range, say you can only sell 30 out of 100 shares, then it will skip your order until it can sell your shares at that price again. And this could be dangerous because it may actually skip a good chunk of your size and not actually stop you out entirely. A trailing stop loss is a much more flexible stop compared to a traditional stop loss. It's more of an actively moving stop loss. So the trailing stop uses, say, 10% or a dollar amount as your stop level. So a traditional stop is like this. If you buy one share at, say, $50, you set your stop at 40, it will automatically stop you out when it hits 40. Even if the price moves up to $100, your stop will stay the same at $40 unless you manually move it. However, a trailing stop loss allows you to say what your maximum percentage loss is. So if you buy at $50, your max stop level is 10%, then your initial stop will be set at 45. As the prices go up, say to $100, your stop will be adjusted automatically to 10%, which is $90. So therefore, your stop climbs as your stock prices move up in your favorable direction. The dollar amount works the same. So your max loss, let's say, is $10 on your $50 share, and your stop is $40. When the price moves up to $100, your max loss is still $10, which is at $90. This stop is great because it's low management. You predetermine the max your loss is, and the broker moves it up for you automatically without your interference. The only disadvantage is that your stop might be too tight as the prices move up, and it stops you out on a smaller profit prematurely. Another two types of orders are limited on open and limited on close. These orders are used when you're away from your trading platform at the open or close of market. So you can place these orders and walk away. Open and close in this scenario means market open and close. So if you buy an LOO buy order, that means the broker will buy your shares if it opens below your limit price. So you can get a fill right away. And if it doesn't meet your criteria, it will cancel automatically. Limit on close is the same thing, but at closing. So let's say you want to set a LOC order, sell order, at the end of market because you don't want to swing these shares overnight. And if your LOC is, say, $50, then the broker will sell your shares if they're over $50 at market closing. Bracket orders are a combination of orders designed for having a stop loss and a profit target in mind. You see here in my broker on the right hand side that you can set a profit and or loss along with your initial order. This means that it's easy to have all your orders set up so that you have a range for the stock to work in. It will automatically take profit when the price hits the target profit, and it will automatically stop out when it hits your stop price. The target exit price may not be clear yet, but your stop should be clear. So it should be easy to set it up all in one order and not have to worry about it. And you can always set your profit limit exit later on the trade. Lastly, we have the duration of your orders. So this is how long is your order good for. We have 6 of these. The first one is day. That means it's good for the trading day only. Once the market closes, the order is auto canceled, and it's the most commonly used one. So even if you set it as day at the beginning of the day or near the end of the day, it will cancel as soon as the market closes. Good till date. You can set a date for this order to be good until, whether it'll be tomorrow or a few days or a few weeks, depends on when you want it to be good till. The third one is good until extended market. So basically it's a day order, except it includes the pre-market times and after hour times, therefore extended market hours. The fifth one here is immediate or cancel. So it's not used that often, but used for stocks that are volatile. So placing an IOC order means that you want shares at a set price, but it may only fill you in a partial position. For example, if you want to buy 100 shares of ticker ABC at $10 and there's not enough shares on the market, your broker will buy as many as they can at $10 for you, which may only be, say, 75 shares, while the rest of the order is canceled, meaning that the order for the other 25 shares you wanted will be canceled. The last one we have here is fill or kill. It's another type of special order. Your broker will have to either fill all the shares at that specific price that you want it for, or the order is canceled. These orders can be used if the ticker is low float, meaning that there's a lack of shares available. I have personally never used them, and likely you won't either, but it's always good to know about them.